In this episode, we speak with Jeff Chapman, head of growth lending at Wellington Management, a global investment firm with over $1.2 trillion in assets under management. Founded in 1928 and headquartered in Boston, Wellington offers a broad platform spanning public equities, fixed income, private credit, alternatives, and multi-asset solutions. Within that, the firm manages more than $400 billion in fixed income and credit strategies, making it one of the world's largest investors in this space. Jeff leads Wellington's growth lending strategy, partnering with portfolio managers, venture capital investors, and the firm's global research platform to back innovative companies. He also plays a key role in developing investment talent and shaping the next generation of leaders within the firm. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of GrowthCap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Jeff, thank you so much for taking the time to chat with us today. It's a delight to be with you.
Yeah, no, thanks for inviting me. I'm excited to do this.
And this is kind of a new one, or maybe it's a recent update, because I don't think our audience is as familiar with Wellington as a whole. So maybe what we could do is top down. Let's start first with the overview of Wellington, if you don't mind. Then we'll go into privates.
So Wellington is a almost 100-year-old asset manager. As of the end of last year, there was about 1.2 trillion of assets under management. The bulk of that is in the public markets, public equities and public fixed income. But we do have a very sizable alts and private team as well. And in the privates group, we have several different equity teams investing equity in some of the same spaces where we are active in growth lending. And then Wellington decided to get into private credit about 4 or 5 years ago. And we now have 3 separate teams within the private credit umbrella. The first was investment grade private placement. We just brought on a real estate team over the last couple months. And then there's my team, growth lending.
And we sit at an interesting time because everything's converging. Public and private seem to be converging in that it can be an alternative to the same company if they're mature enough. And then you have private equity and private credit that are somewhat converging in that they're both viable solutions to the same private company. Let's talk more specifically about the private investing. You gave it a good overview. How would you kind of roughly break out the activity? Where is the activity most prominent if you were to take a look at the whole pie of, where assets are invested in the private market?
Well, I guess to answer your initial question, I agree. There is definitely a convergence. That's where our first group within our privates team on the equity side started. It was actually a guy by the name of Michael Corman, who was active on the public side, who decided to step to the private side to capture additional return. So literally a public investor starting on the private side. And we have now a lot of interaction between public and private. I'm very fortunate at Wellington where I can utilize resources across the firm. One of those resources is our public equity analyst. So as I'm looking at new growth lending opportunities, I can actually get a public equity point of view on my private credit transaction, which is very unique and a huge luxury for me.
Mm-hmm. Let's go right to growth lending. So tell us about the types of loans that you do provide, the types of credit, and the sectors that you deal with.
Yeah, sure. So fundamentally, if folks aren't aware, growth lending, some people call it venture debt, is fundamentally lending against the enterprise value of a business rather than its cash flows like you might in traditional middle market lending. And it's an asset class that's actually been around since the late 90s, so over 25 years now. And it's grown more or less year over year, every year since, except for, I guess, 2023, which we could talk about more later. But these loans, 2024 ended up being a record year, I should say. So 60 billion roughly of loans were issued, which is a very meaningful amount of capital within the venture ecosystem. These loans are typically priced in low double digits to mid-teens for BDCs and private credit funds that are active. The commercial banks lend a little bit less expensive. but they do typically come with warrants. So if you're a lender and one of the companies that you're lending to has a big exit, that will actually flow back to you by way of additional loan returns. And one thing I think that's surprising to people about this space is the loss rate, the annualized loss rate for these loans is actually very low. It's about 1% historically, which I think most people think if you're lending to, these are primarily venture-backed companies, there might be defaults all of the time, but that just hasn't been the case historically.
And is that mostly the case because you sit on a more senior part of the stack?
Yeah, that's definitely part of it. So you're senior to all of the equity. Also, at least our strategy is we're lending to late and growth stage, primarily venture-backed companies. So these are much more mature companies than people might think of if they're thinking of a startup that might be a seed or a Series A or a Series B. And so these companies are commercial and growing. They've got strong business fundamentals and unit economics. And we're looking for ones that have a clear line of sight on profitability. So there might be one equity round in the future, maybe two, but we're often last money coming in, maybe alongside the last equity round. So these are companies that can absolutely raise equity, but they're choosing not to, or at least choosing to complement equity with credit because they don't want the dilution of equity. So most of these companies are pretty near an exit, and the management teams and the boards are sensitive to dilution at that point.
And it seems like a large part of your background is in healthcare and life sciences. Is that where a lot of your growth lending is focused as well?
So yes, I did start out as a scientist many, many years ago. And a lot of my investment activity over the years has been in life science and healthcare IT. Our goal for this platform is to have a diversified group of companies. So of course, there will be life science and healthcare, but we want it to look generally like venture looks in general. So think broadly investing across tech and then life science and healthcare also.
And how competitive is this market? Do you find there's a lot of other growth lending participants?
It is competitive. It's been a very interesting past 5 years in venture in general, but it is a competitive market. There are commercial banks who are active. Of course, Silicon Valley Bank was and still is active in this market, as are other commercial banks. There are several BDCs that are active in this market, and then there are private credit funds and then larger asset managers as well.
And how do you like to differentiate your offering, Wellington growth lending versus the others?
Yeah, well, I guess I alluded to this earlier, but we're very fortunate at Wellington to have such a large institution behind us with all kinds of resources that smaller BDCs or private credit funds just don't have the luxury of having. So for me personally, on the investing side, a lot of those resources can go towards diligence, which is fantastic. They also can go into sourcing. So of course, me and my team have our own sourcing networks. These deals are actually not that easy to find if you're not in the community, but our networks get expanded exponentially throughout the Wellington investor network as well. So that's great from an internal perspective. I think we've got a lot of tailwinds. Externally, because Wellington is such a large asset manager, it's not lost on these small companies, management teams, and boards that Wellington could potentially invest from a different capital pool down the road. So of course, if the company grows, my team could provide more credit, but we have private equity teams that could decide to invest private equity into the company, or we have public investors. So we could take these companies public. We could come in at scale once they're already public companies. So if I'm a venture-backed company, I'm looking at some options for where to take credit. Getting out of the Wellington platform, I think, is pretty compelling.
It seems, and I might be oversimplifying this, that if you're late stage, you play mostly in this kind of like mid to late stage venture, that you wouldn't really overlap with growth equity as much. If we think of traditional growth equity, I think venture growth, yes, but growth equity, maybe not. So for those CEOs and founders that are contemplating where should their next dollar come from, is that more the case? Like, okay, I'm venture backed. I would categorize myself as venture growth. Maybe I could consider both a venture equity round or a venture growth lending round.
Yeah, well, I think we bleed across both. So the way I describe it is, think late stage venture or growth stage growth equity. So we really can't expand across all of those. As far as on the lower end, think a company that has maybe 15 or $20 million of revenue, but then we can scale way up from there. We actually just closed a loan with a company in the hundreds of millions of revenue. So we really can span those. And the goal really is to be a counterpart to our late stage growth team. So to be able to offer credit, just like we already offer, equity to those companies as well.
And generally, what is your check size?
So we have a wide range. I would say on the lower end, somewhere equivalent to the revenue size of 15 or 20 million. And then we can scale up, with partners of Wellington into the hundreds of millions as well.
Okay, got it. Is this like you're purely focused on this segment? Do you go into other areas with more mature companies, or is that a completely separate lending group?
Yeah, no, it's a good question. So most of the companies we're working with are burning cash. They are focusing more on growth than they are on profitability. But it's not like the minute that they actually turn EBITDA positive, we don't want anything to do with them. So there are absolutely companies that, I would consider more cuspy that have actually grown quite a bit, have decided to focus on profitability and have some amount of EBITDA. I would still consider them growth stage companies relative to like a more traditional lower middle market company.
Got it. And just comparing to your equity counterparts, is there other value that growth lending brings to the table aside from the financial capital and, maybe a more palatable structure? Are there other kind of ways you help the company?
Well, I guess from any equity investor's perspective, credit can give them a levered return. So we can potentially help capitalize these companies, and everybody involved could end up with a better return overall once there's an exit. As far as how we work with companies, I think within Wellington, it's, I would say, hopefully beneficial to the rest of the teams on the private side that we are another group of investors with our own networks. And there's a whole lot of collaboration between the teams and introductions back and forth. And so maybe a company is looking for equity and they end up coming to us first. Well, we can easily pass them along to the folks on the equity side. And likewise, that happens quite a bit as well. And then as far as, how these companies, it's what I alluded to earlier, because we're such a large institution with resources, I think there's really a path here for any company to be a large, successful public company along the way. I didn't mention the fact that we also have here a value creation team on our private side that actually works with companies. And we really do try to make sure that every company in our portfolio is as successful as they possibly can be.
Mm-hmm. It's kind of like referenced earlier, the private credit markets is experiencing a boom, has been and continues to. Are you also seeing that in growth lending, or is it more kind of a continuity from what's been around for decades?
It is a very interesting time, like I said before, and we could spend a minute, I guess, talking about venture in general and try to weave credit into that. That's interesting. But I would first say that the past 5 years or so has been unlike any other that I've seen in my career. I mean, on the equity side, what we saw, of course, in 2020 and 2021 was this record amount of capital raised, record number of deals done, and record number of companies formed. So there's now over 60,000 venture-backed companies, which is a massive number of companies, especially if you compare it to, say, the US public companies at roughly 4,500 or more traditional PE companies around 13,000. So this is a huge demand for capital that's been created within venture. Mm-hmm. And if you just fast forward a year from there, what we got was an inflation spike, interest rates go up, and then there's a lot of downward pressure on exits from there. So all of this demand for capital, all of a sudden those exits are closed. And at the same time, fundraising for venture equity funds dropped pretty dramatically. So the supply of equity dropped at the same time, or just after there was this huge spike in demand. Fast forward the next couple of years on the equity side, certainly there's been a pickup from 2023 in deal activity. And now in 2025, there's actually, I would say, a boom in deal activity, especially in the growth stage, especially in AI related companies, a real push on valuations and size in what's become a very concentrated investing market. So just a handful of companies, most of which are AI companies, are really hoovering up most of the capital. But then if we weave in that your question was on private credit. So if you think about the credit markets, well, obviously 2023 was that impactful year with the collapse of Silicon Valley Bank. So that was a drop in the number of loans since they were the largest lender in the space. But this demand supply imbalance that I mentioned earlier, it's not lost on lenders. So there are all these companies that need capital. And so lenders really ramped up activity in 2024, and that led to a record year. So like I said before, roughly 60 billion of loan issuance. And now in 2025, we're seeing that same pace. So there's roughly 30 billion issued in 2025. But we're also seeing similar concentration that we're seeing on the equity side. So it's the same pace as 2024, but it's in 30% fewer companies. So larger loans to fewer companies. So that same thing is happening, but there is absolutely a boom on the credit side because there's such a big demand from all of these companies.
Excellent. We're coming up on the tail end of the conversation. I have two final questions. One is, can you tell us about a person who has had a profound influence on you?
Sure. Well, there are many investors at Wellington that have already, just in the past year and a half, had a large influence on me, both public and private. But if I'm being honest, the person who's had the biggest influence is my dad. Well, he was trained as a mechanical engineer at Stanford back in the 70s. And he is extremely detail-oriented and meticulous and very patient in his ability to focus on a problem to get to the right answer. And I grew up in that environment, and I've certainly tried to take some of that with me in my investing career.
Excellent. Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
Sure. Well, I grew up in a photography household. So we literally had a dark room built into my home in Tucson, Arizona. So that was always an interest of mine. I love the combination of creativity and the technical or math component even. And so as I grew up and became an adult, it's a great hobby when you've got little kids. But now that they're in high school, they're very athletic. And so I've gotten very into sports photography. So I actually volunteer for my son's soccer club. I do all of their media. And then I'm a official photographer for their high school. So I do all their varsity sports photography, football, soccer, volleyball, tennis, you name it. So it's a lot of fun for me. And I guess if I judge by the number of my photos that end up on the kids' Instagram, I think they like it too.
That's awesome. What's your camera of choice?
So I have a Sony A1 II and a ridiculously large 400 millimeter 2.8 lens.
Awesome. Jeff, want to thank you again for taking the time. It's been a wonderful conversation.
Yeah, thank you very much. I enjoyed it.